Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video recap that we do here each and every night, where we go over all of our opening trades and then any closing or adjusting trades that we had made today. So today we actually had a fairly active day with 3 new orders that went into the market. We had a lot more working, but just nothing that really hit with fills. And tonight we're going to go over 2 vertical credit spreads, call credit spreads in particular for LinkedIn and CAT, which is Caterpillar. And then we're also going to talk about our closing trade on Nike, which is our Nike Strangle that we had. Really, it was an earnings trade where we had sold a Strangle before earnings. So before I go over LinkedIn and CAT, I do want to focus on Nike to begin with, because I have the Thinkorswim chart set up that we'll go over here right after this. But here was the setup on Nike, and I'll go to the charts after I talk about the actual closing order. So the closing order for Nike was that we bought back the April 14, which is just April 2014 contracts. We bought back the 77.5 puts, I'm sorry, the 77.5 calls and the 75 puts. So we actually had originally a very wide strangle in Nike, and we made an adjustment throughout the cycle, and we actually got rid of, we had around some 80 calls and rolled those down to the 75 puts. So we actually turned it into an inverted strangle, which really doesn't happen that often, but it is a good strategy. And you can see in this case, we actually turned a small profit of $45 at the end of the day. So we bought back that entire strangle today for a $425 credit. Originally, we had sold the original strangle for $260 as a credit, and when we made the adjustment, we actually adjusted very far, very fast after Nike's earnings and took in an additional credit of $210. So we had a $470 total credit that we were working with that helped make our strangle really wide after Nike's earnings. And then obviously that's come in a little bit in coupling, really because of 2 factors. One, Nike has come up a little bit since its runoff after earnings, and implied volatility has dropped. So if we go to the chart here, we'll take a look at Nike. This is a chart of Nike here today. And what you'll notice is down in the bottom corner or the bottom section of the video, this is a chart of implied volatility specifically for Nike. Now, again, we've gone over numerous times in videos the difference between the IV rank, which is up here in the top left, and the actual implied volatility. So IV implied volatility on Nike right now is 18.5. And that rank is in the 36th percentile, so it's below the 50th percentile. Now you'll notice that we had this huge sharp drop in implied volatility for Nike after its earnings. So in Thinkorswim, the earnings are designated by these little icons right here that show the earnings, and you'll see that the stock gapped lower after earnings, and implied volatility just absolutely got crushed down right after earnings. And that's what we wanted to see happen. We wanted to see that implied volatility get crushed down. What we didn't expect to happen was the continued runoff in Nike after the days that we had originally entered this trade. So our first trade was actually, our first put side trade was actually at 77.5. So our first put was at 77.5, which is right about here, and you can see that Nike opened up right above our level, and then that day continued to run down, so that option was actually in the money. Now what we did is we actually rolled down our call side trade and sold the 75 calls. So we actually turned this thing inverted. We had calls here at 75, and we had the puts at 77.5. So we were inverted. And ideally what we had wanted to do is for Nike to trade and close in between basically those 2 ranges, right? And our break-evens moved it out a little bit further. But what we actually had is we actually had Nike, and this was a good way to just adjust the trade, but Nike kind of rallied up, which absolutely helped our position, and implied volatility dropped. So these 2 positions both lost value very quickly because of the drop in implied volatility. So their pricing went down. Now, because of this trade adjustment and being quick and aggressive with your adjustments, and that's really what this is a great tutorial on, because of these trade adjustments, we were able to recenter the strategy right around 75. So we were able to kind of recenter the strategy right around our call spread at 75, and that allowed us to then wait it out a little bit longer for implied volatility to continue to drop and for Nike to possibly make a pop up here. And so after it did all of that, we actually closed out the trade today, closed out both sides of the trade at the same time, and bought the entire position back. Now, somebody asked, Kirk, why, I got a comment earlier today in the membership section saying, Kirk, why do we close this out for a $45 profit? Now Nike's back inside of our range, implied volatility is dropping. Why not hold this thing all the way till April expiration? And the reason that we're not going to do that is because this is not a defined risk strategy. So we are short 2 naked options, one on either end of the market. And because we have that kind of overarching undefined risk on either side, that gives us a huge amount of usage in our portfolio for margin and for just buying power generally. So what we want to do is with these trades that are undefined risk trades like strangles and straddles, things like that, you want to actually be a little bit more careful about how you manage that position. It would have been great to obviously hold this a little bit longer, but I just don't know if Nike's going to continue to move higher and implied volatility is going to drop. It's just not a good risk reward at this point. We actually made an adjustment, so what was originally going to be a really, really big loser turned into a very small profit. So at this point, we want to take this as a win and chalk it up in the column and move on to the next trade. Of course, we would have liked it to be a much bigger win, but we'll take the $45 profit and move forward. All right, so the opening trades that we made today are very, very similar in nature, and they are both on LinkedIn and CAT, which is Caterpillar. So for LinkedIn, what we did is we went in and sold the 200 calls and then went back in and bought the 205 calls, creating this vertical call spread. Now the width of the strikes is about $5, and we took in a credit of about 105. So it's almost about 20% of the width of the strike, so it's about an 80% probability of success trade. I'll go to the charts of LinkedIn here so you guys can see, and I'll drop the implied volatility down here off because we talked about it in a number of videos and it just muddies up our charts. So here's a look at LinkedIn, and it just continues to move lower, lower, lower. So we're actually going to play the downside to this. Usually we might actually want to sell a put spread below the market, and obviously if you're bullish in LinkedIn versus we're bearish in LinkedIn, then you would sell a put spread versus the call spread. But the key here is obviously that implied volatility is in the 60th percentile or very close to it. So that allowed us to get fairly far from the market selling the 200s as our first short strike at 200. So this gives us plenty of room between ourselves and the market. And obviously LinkedIn is a very quick mover. It's very volatile. So we obviously want to be careful about that, but it is a risk-defined trade. So we have risk definition on this by buying the extra 205 call above it. We've defined our risk between this area and below, and so that leaves us a lot of flexibility to leave this position on and hopefully see a drop in implied volatility that will come in the next couple weeks. The other trade that we made here today is on CAT. So CAT has had a huge run up and continues to see implied volatility run up as well. So what we did is we went in and sold the 105 calls and bought the 110 calls as protection. Now between the selling and the buying of the 105s and buying of the 110s, we took in a credit of 110. So in this case, we took in almost about 20% as well. It's very similar to what we did in LinkedIn. We'll go to a chart here of CAT, and you can see just how quickly this stock has moved higher. It seems like it's kind of gotten some new legs here, but again, I think it's gone a little bit more parabolic than we like. Now, we traded options that are all the way out till May, so we have a long time period between us and expiration. Expiration isn't even on this chart. These dotted red lines are always showing the expiration date. So by trading the May contracts, which are really further out, we give ourselves a lot of time to be right. So a lot of time for Caterpillar to move down or even sideways before we actually start to lose money on this trade. So again, our strikes are way above the market here, giving ourselves room, and obviously the stock has had almost a parabolic run here recently, so we think at some point there's going to be a little bit of selling off. But again, the key here with the strategy selection, so why we chose a credit spread versus a debit put spread, is that implied volatility is above that 50th percentile. This gives us an opportunity to then sell premium at a much higher price than it usually is, and that allows us to get that extra edge in the market. So with these types of positions, you can be a little bit more aggressive with how many contracts you trade, how much of your portfolio you're trading these, because they are a higher probability trade. You don't want to do this. You don't want to be too aggressive when we trade some of the debit spreads. Those are more directional trades. We're just trying to take advantage of a directional move, not really a volatility move in the underlying stock. But in things like CAT and LinkedIn today, these are great examples of trades that you want to make, again, that are a little bit wider or a little bit bigger than you normally would with your allocation because they are a higher probability trade. Now, again, I had another email from somebody else saying, Kirk, Walt, what if I'm continuously bullish on CAT? So what if I think actually CAT's going to go higher? And again, it doesn't matter which way you think CAT's going to go. Same thing with LinkedIn. What matters more so than your direction is what strategy you choose and where implied volatility is. So if you are bullish on CAT, or you just need some positive delta in your portfolio, so you have way too many shorts and you want something that's a little bit bullish, then you would go in and find something that's very similar to what we traded here and sell a debit put spread on the other side of the market. So let's go in here and just take a look at that real quick so you guys can see what I mean. We have here our position in CAT below, as always. So you can see our position in CAT down below. We're down about $5 today, so it's just very minimal movement in the security today. But we open up the May options, and you'll see that our strikes are right here at 105 and 110. So we're trading about the 30% probability level. So when we actually made this trade, it was around 25, and our break even pulled it out to around 20. So right now we're trading with about 70 to 80% chance of success depending on when you got into the trade. If you wanted to make the same probability trade on the other side of the market, because again, it doesn't matter which side you're trading, and you want to make the same probability trade, then what you would do is you would go down to the 97.5 puts and trade a $5 wide strike. So you trade the 97.5 and the 92.5. And you'll notice that the 97.5 has about a 30% chance of being hit as well. So it's a very, very similar distance away from the market, and therefore a very similar probability. So again, if you need positive delta in your portfolio, or if you're bullish on CAT or LinkedIn or any other security that we trade in our membership program that we send out alerts on, and you just want to trade the opposite side, all you have to do is match up your corresponding probability right here in the platform. So again, hopefully you guys really enjoy these videos. As always, please ask a lot of questions. That's how you guys learn. I know I don't say that enough, but please add comments to this video, share this video with other people that you know that trade. We want to get our name out there, obviously, and we think that we're doing a great job here educating everyone. So as always, if you have any questions or comments, add them right below to the video. We'll get back to all of those tonight or tomorrow before the open, and happy trading.